think investors today are looking for REITs to conservatively manage their balance sheet, both on an equity and debt basis. But they're also looking to see where future growth opportunities can come from.
I'm here today with Michael Koster, head of U.S. Real Estate Investment Banking and M&A at TD Securities. Can you talk about the state of the capital markets today and how it might impact REITs for the remainder of the year?
I think the state of the capital markets is still a little choppy. However, we do see improvement. And we have seen improvement both on the debt capital market side and the equity capital market side sequentially month over month since the beginning of the year. We're certainly not back to 2001 type of numbers, but we do see more issuance and a little more stability. I think the market is open certainly for the highest quality issuers and also issuers that need to come to the market. There'll be a price to pay, but you can get in the market. I think the bank market continues to remain challenged. The ability to do a large syndicated credit. There are just not as many banks and certainly not as many regional banks. We hope that trend will reverse sooner rather than later. I think based on TD's view of where interest rates are going, we do expect a 25 basis point cut by the Fed towards the end of this year, coming in the fourth quarter. And then as the economy softens, we expect to see the Fed accelerate their rate cuts in order to create more of a soft landing. And our corporate view on those cuts is somewhere around 200 to 250 basis points coming in 2024. The net result of that should be positive for REITs. It should have a very positive impact on the bank market. It should have a positive impact on the debt capital markets. It should have a positive impact on the equity. I mean, all of this, as you know, we require movement and cycling. So the extent that the debt capital markets can open up, then that can take some pressure off the banks and the bank lines so that they can get flushed out and then the equity can be used and we can get back to a more normalized situation. We're all hopeful, but we're starting to see early signs of that.
And in your view, what are investors most looking to hear from REITs at this time?
So I think all markets generally, and certainly the real estate markets, are looking for signs of stability. And so I think investors today are looking for REITs to conservatively manage their balance sheet, both on an equity and debt basis. But they're also looking to see where future growth opportunities can come from. And so I think it also is a sector by sector decision. A conversation with a self-storage REIT or a life sciences REIT is going to be very different than what an investor is going to have with an office REIT. And I think the cloud over return to work in office continues to weigh on the market and certainly continues to weigh on the share prices of the office REIT.
And what are some of the ways that TD Securities works with REITs to help them do business better?
So I think one area that we have spent a lot of time on is, as you probably know, that real estate is somewhat unique in that there is such a large sector of the commercial real estate market that is held privately by institutions. I don't know of many other industries where that exists. So there's a constant arbitrage in terms of cap rates between private market and public market. We call it Main Street and Wall Street, and we're constantly tracking where that arbitrage exists. Right now, the arbitrage is in favor of the private markets. The private markets are paying better cap rates, lower cap rates than the implied market cap rates for public companies. And so what we're starting to see is a continuation of REITs taking advantage of that and creating public-private partnerships. And that allows REITs to continue to grow and make acquisitions, because this is an interesting time to make acquisitions if you can find the right thing at the right price.